The reality is most people delay planning for retirement because they think it's complicated or they figure they will just get to it someday. But with the right approach, it does not have to be difficult. And it's something you should get started as soon as you can. Another issue is that people aren't aware of the key strategies that could help them prepare for retirement today. So today I'm going to walk you through the 5 essential steps to building a retirement plan that helps you work towards your financial confidence in the future. I'm going to break it down in a way that is both practical and actionable, so you can start making informed decisions now about your future down the road. Now, if you're new here, my name is David Millington. I'm a certified financial planner professional and president of Puzzle Wealth Solutions. I've had the privilege of working with individuals and families for over 2 decades. I've also been recognized by Forbes as one of the best in state wealth advisors in 2021 and 2024, and I'm ranked number 56 in the country by the US Today by Advisor Hub. So let's get started on the 5 essential steps. Step number 1, understand your retirement starting point now. Before you can plan where you're going, you need to know where you stand today. The first step is assessing both your financial and your personal retirement readiness. From the financial standpoint, this means the following: looking at your income, gather details on your current retirement savings, Social Security estimates, and pension or investment income. When it comes to expenses, understand your current goals and estimate how they may change once you get into retirement, because they will. On the personal side, it's important to consider this: your goals for retirement. Do you want to travel, start a business, or simply maintain your current lifestyle? You need to start thinking about that now. Also, the lifestyle choices that may impact your financial needs, such as might you need to relocate to follow your kids, change your healthcare costs. This first step is essential because without a clear picture of where you stand, it's nearly impossible to create a plan down the road that aligns with your long-term goals. Your second step, determine your required retirement income. You can do this by calculating how much income you may need each year in retirement, as your goals will likely fluctuate. You can't do it one time. You need to see where it might change. So a common strategy is the replacement ratio. Suggest aiming to replace roughly 70 to 80% of your pre-retirement income. However, this varies based on individual circumstances. So to estimate your required income, do this calculation. 1, identify and add up your expected or fixed expenses like housing, healthcare, utilities, insurance. 2nd, factor in discretionary spending, entertainment, travel, hobbies. So add that to your fixed expenses. Next, subtract your guaranteed income sources like Social Security, pensions, fixed annuities. And in the end, the remaining amount is what you may need to generate from your personal savings and investments. So as an example, if you determine you need $180,000 annually for expenses, Social Security is $30,000, that means your investments may need to generate the additional $150,000, or the principal needs to get drawn down. 3rd step, structure your investments for retirement income. This is where the strategy comes into play. Your retirement portfolio should be structured in a way that balances growth, stability, and income generation. Growth investments. These may include diversified stock holdings to help combat inflation. Income generating investments. Think of dividends, rental income that can provide consistent cash flow. But also stable assets, cash reserves, bonds. They cushion your portfolio during market downturns. Even if you want mostly risk, stable assets provide you a dry powder that you can deploy when the markets really sell off. You'll be glad you left some on the sidelines when those opportunities arise. On the flip side, portfolio strategies having a withdrawal strategy is critical. Many retirees use the 4% rule, which suggests withdrawing 4% of your portfolio per year. However, that's a general guideline, and personal factors such as market conditions, tax efficiency, healthcare expenses need to be considered. My strategy deviates a little from that 4%. If you're 60, that's a fair assumption. However, if you retire younger, you should target a lower percentage. But if you're 70, you can target up to 5% and likely still be in good shape. So step number 4, you need to plan for the risks that should derail your retirement. Even the best plans should account for unexpected risks that could impact your retirement. Here are 3 key risks to plan for. 1 is that market volatility. A down market in early retirement can really impact the portfolio's longevity. Having a cash reserve for 6 to 12 months of expenses can help avoid selling investments at a loss. Create a target equity range and try to stay in that range if possible. When the markets seem a little extended on the upside, think the end of 2024, you might want to look to position a portfolio in the lower half of your range. By doing this, when the markets sell off and you might be below your range, then you can unemotionally start to buy when others freak out. This is how you can build a good portfolio over time. Another risk is healthcare costs. Fidelity estimates that a 65-year-old couple may need approximately $315,000 for medical expenses in retirement. Considering options like funding long-term care insurance at a younger age or waiting to tap into your HSAs can help prepare for these costs. And then a third risk is inflation. Historically, inflation's been around 3%, meaning your expenses will double over 24 years. Investing in assets that can outpace inflation is key. It's best to have a blend of growth and stability no matter what your risk tolerance is. So those are 4 steps. And now the 5th and final step, regularly review and adjust your plan. A retirement plan isn't something you just set and forget. It requires ongoing monitoring and adjustments. Life circumstances change. The markets shift. Tax laws evolve. Your portfolio needs to do the same. Here's what to review at least annually. With your financial plan, are you on track with your savings and spending goals? Has your probability of success changed? I review this with nearly every client in January of each year. This gives them confidence to know where they stand, whether the markets are up or they're going through a rough stretch. With taxes, are there strategies you can implement? I usually review this with my clients in the 3rd or 4th quarter each year. Looking at your portfolio, has your risk tolerance or investment strategy changed over the last year? And then last but not least, do you need to adjust your withdrawal rate? And if so, does this possibly put you in a position where your probability of success is now below a certain threshold? A good rule of thumb is to revisit your plan every single January or when a significant life event occurs, such as a career change, inheritance, or unexpected expenses. Building a retirement plan that helps you work towards financial stability doesn't have to be overwhelming. You should rely on a financial professional like myself to know how to ask all the right questions and provide the correct interpretation of that data. Using too simple of a calculator can give you a false positive. By following these 5 steps, assessing where you are today, determining your income needs, structuring your investments, planning for risks, and reviewing regularly, you can create a well thought out strategy that aligns with your goals. This is truly where the foundation of long-term success is built. If you'd like to take the next step in customizing your retirement plan, click the link in the description below to schedule a consultation with me and my team. Thank you so much for watching. As always, I truly appreciate you, the interest, and the support. I look forward to seeing you all in the next video.